Ladies and gentlemen, this is an urgent, critical warning that could change everything. Over the past 48 hours, we've just got some new news and we have seen some huge changes by central banks all around the world. And we have just got a huge warning from the United Nations telling the Federal Reserve they need to stop lifting interest rates and stop right now. Otherwise, we're going to have a global recession, which really would be a depression. And we're also going to have a foreign debt crisis, and all the other fiat currencies around the world are going to collapse. But what you have to know is the economy is not the markets. And the markets, all they want to know is, will interest rates go lower and will they get their cheap debt and their free money? But everyone, that could have huge consequences for the rest of us. So with the markets rallying yesterday and today, is now the time to buy? Is it time to sell your wife, sell your dog, sell your firstborn, take your kid's college fund and use 10x leverage and go all in Bitcoin right now? Well, everyone, this is going to be a very important update to see exactly what is going to happen in the markets. So let's not waste any time. Let's get straight into the news, the facts and the data. Okay, everybody, first story hot off the press this morning. Read all about it. The UN has warned higher interest rates represent an impromptu gamble, UN agency warns. Well, everyone, the global elites are now starting to panic, and the global central banks around the world are starting to panic, and they're not really liking the Federal Reserve right now, especially with the surging dollar that is sending their currencies collapsing, like the Japanese yen, the British pound, the Australian dollar, the yuan. They're all quite angry with Papa Power right now. But all jokes aside, the Federal Reserve is going to come under huge pressure to stop hiking interest rates and to turn the money printers on again. And that's one of the pieces of the puzzle why the markets rallied yesterday and today, but also not to mention there's been huge amounts of short positions, there's been huge amounts of put positions. What's happening is there's a huge short squeeze going on right now. In its annual report on global economic outlook, the United Nations Conference on Trade and Development said interest rate increases and austerity policies in wealthy nations represent an impromptu gamble that risks backfiring, particularly on lower income nations. And this is what I've been talking about and warning about everyone. I've been saying that these countries that have a weak currency, they have a lot of debt in US dollars. And so what this simply means is they're going to have to print more and more of their currency, or they're going to have to use more of their currency to pay back their debt that is in dollars. But with the global economy in a recession, they simply don't have these funds and they're going to be facing default. We're seeing this happening around the world, like what's happening with Sri Lanka. Pakistan's on verge of default. We're seeing hyperinflation in places like Argentina, where they had to lift interest rates to 75%. We're seeing 83% inflation in Turkey. Things are getting very, very serious, everyone. There's still time to step back from the edge of recession, they said. We have the tools to calm inflation and support all vulnerable groups. I find this is funny, everyone. These central bankers and these elites, they keep saying, we've got tools. We've got all kinds of tools, big tools, little tools. But they don't specifically say what tools they have. They just say the term, we got tools. People, everyone, they don't have any tools. The emperor has no clothes. But the current course of action is hurting the most vulnerable, especially in developing countries, and risks tipping the world into a global recession. The agency estimated that a percentage point increase in the Fed's benchmark federal funds rate, aka the interest rates, reduces economic output in other wealthy nations by 0.5%, in poor countries by 0.8% over the next 3 years. Okay, so what they're saying here, for every time the Federal Reserve lifts interest rates, this reduces GDP in wealthy nations by 0.5 percentage point and by poorer countries 0.8%. So we see here how this has a direct effect on the global economy. Lower income nations will already see economic output tumbled by about 360 billion over the next 3 years as a result of the Fed's rate increases so far this year. That is extraordinary, everyone. These nations, from what has already happened, are going to take a $360 billion hit. This is going to have severe consequences, and unfortunately, even if they do stop lifting interest rates or they slow the rate increases, they're not going to be able to drop them anytime soon. But the Fed chair Jerome Powell has all but conceded the central bank will tip the economy into recession with its rapid rate hikes, warning that higher rates will cause economic pain. The Federal Reserve has already lost huge amounts of credibility. They were already wrong on inflation being transitory. They were already wrong on peak inflation. Now they're trying to do a lot of bark. They're not really doing much biting, or they have been biting a little bit with these 0.75% interest rate hikes when they really should have been doing 1%, so I don't think they're going to be able to pivot as soon as the markets are hoping. The chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer, Powell told reporters in Washington in September. Nonetheless, we're committed to getting inflation back down to 2%. We think a failure to restore price stability would mean far greater pain. And he's exactly right there. There would be far greater pain. Because the thing with lifting interest rates is if you go too high, well, you can always lower interest rates immediately. But if you don't lift interest rates high enough to stop inflation, and if inflation gets out of control, you can't just lower inflation in half in a month like you can with interest rates. Unfortunately, central banks around the world are starting to play this gamble, and it is a dangerous, dangerous game that central banks played in the 1980s that led them having to lift interest rates to 19% to stop this surging inflation, and I fear they're going to make the same mistake again. New government data released last week showed that the Fed's preferred inflation gauge, known as Personal Consumption Expenditures (PCE) index, accelerated more than expected in August, suggesting that the underlying inflationary pressures remain strong. So what we're seeing in the markets right now is the speculators speculating that the Federal Reserve is going to pivot, kind of like the Bank of England did when they started QE again by buying bonds because their bond market nearly collapsed, with pension funds getting close to being margin called on $1.7 trillion worth of bonds. Look at this, Fed pivot trade sparks again as bonds rally and dollar weakens. The move came as traders trimmed bets on future rate hikes, with money markets signaling that the Fed funds rate will peak by March, and the 2-year Treasury yield briefly slid below 4% for the first time since September 21st, and again short-dated bonds rallied even more, with yields down as much as 16 basis points to 1.46%. But we've seen these traders try to play this game all year, and unfortunately it's always led to them getting wiped out and us hitting lower lows. Those trying to call an end to the relentless rise of interest rates have been burned before. Hopes that an economic slowdown would start to tame the march higher in prices have largely proved misplaced so far. And speculation over the summer of a Fed pivot was dramatically shut down his comments from Fed Chair Jerome Powell at Jackson Hole in August. So it's going to be very interesting to see what the Fed comes out and says with all the situations that's going on in the markets right now, especially with the financial instability we're seeing in the banking system with companies like Credit Suisse in big, big trouble. But in order for us to have an idea of what could possibly happen in the future, the best thing we can do is learn from history. So what happened last time when inflation was this high? What did central banks do, and what was the consequences? Well, everyone keeps comparing this time to the 1980s. So I went back to the Federal Reserve's chart of interest rates in the 1980s, and look at this. What they did was in 1980s, they lifted interest rates to 17%, and they thought they defeated inflation and dropped them back down to around 9%. But no, inflation surged again, and then they had to lift interest rates to 19% in 1981 to bring down this inflation beast. So if you think the Federal Reserve and other central banks around the world are going to stop inflation with 3 or 4% interest rates, people, you need to think again. Now, I don't think they're going to have to go to 19% because there's so much more debt in the system. Debt to GDP in the 1980s and 1970s was around 35% of GDP, where it's now around 125% of GDP. So like I've been talking about consistently, I've been saying they're going to have to go to at least 5% to even have any chance of stopping inflation. And some more news that we got today that's giving these bulls a lot of hope is what happened in Australia with the Reserve Bank of Australia, with what they did with interest rates, which absolutely shocked everyone. It shocked mainstream media, it shocked all the economists, and it shocked myself as well. So the RBA, Reserve Bank of Australia, surprises markets with a 0.25% hike and currency tumbles. So this was shocking everyone. All the analysts, all the markets had priced in of minimum 0.5% increase in interest rate to 50 basis point increase, and they only went 0.25%. Why did they do this, everyone? Is there some weakness in the financial system, in the global financial system? Well, I think we obviously know that, but is there something much worse underneath the hood in the plumbing of the financial system that is about to break that they haven't told us yet? Well, again, if you want to know the truth, you need to follow the money, and not by what they say, but what they do shows us what's really happening. So I think there is something really bad going on underneath the surface, and that's why the Reserve Bank of Australia pivoted today or not really did a hard pivot, but only increased 0.25% instead of 0.5%. And we all know Australia is obsessed with real estate in the housing market, and there is big pain coming for the Australian housing market. We just got some new data to show that house prices are falling rapidly, and this is happening around the world, in the US and the UK as well. So look at this chart here. This is the latest CoreLogic data. We can see here this month, September, Sydney fell 1.8%, Melbourne down 1.1%, Brisbane down 1.7%, and that brings the quarter losses down to 6.1% for Sydney, 3.7% for Melbourne, and 4.3% for Brisbane, and it's down 4.1% nationally now. That's just in the past quarter, and Sydney is already down around 9% from their peak. And this is just the beginning, people. And even if the RBA stops lifting interest rates once they hit 3%, there still is going to be a lot of pain in the housing market. House prices rose so rapidly, and what a lot of people in the US may not know, there's a lot of people, 60% of mortgages in Australia are on variable rate mortgages, so they get hit with increases straight away. And a lot of people fix their mortgages in 2020. That's what I did as well. We could get fixed rates below 2%. Well, they're going to be expiring next year and the following year. And also, there's a lot of people who got interest-only mortgages. They can't even afford to pay the principal back, so they got interest-only mortgages. Especially a lot of investors got interest-only mortgages. They're going to be expiring. All the people that had these mortgage holidays, I've heard, even some people still had them extended up till now. Well, they're going to have to start repaying their money there as well. So everyone, the question we all want to know, is now the time to buy? Is this the bottom in the stock market? Is this the bottom for cryptocurrencies? Should we go all in now? Is it time to buy the mega dip? Well, people, it all depends on what the Federal Reserve does. They are the central bank leading these markets right now. We've seen a couple of other central banks start to slow or ease, like with the Bank of England, with the Reserve Bank of Australia. But if the Federal Reserve pivots, yes, even though I am pretty bearish, that will be bullish in the short term for the stock market. But what this is going to have severe consequences. We're going to see inflation accelerate rapidly. And what that's going to lead to is, yes, while central banks may pause now, or they may even drop interest rates next year, that's going to cause inflation to accelerate, just like what happened in the 1980s. And then central banks are going to have to lift interest rates even higher than they would have had to if they just kept on the same path as they were meant to right now. And what that will lead to is an even bigger crash in the future. But again, this all depends on if the Federal Reserve does pivot or not. If the Federal Reserve comes out and speaks to the media next week or next month, or they have an emergency meeting and they say, no, we are going to keep lifting interest rates. We are going to keep selling our mortgage-backed securities and our US treasuries, while we're going to see the markets tank much, much lower. But everyone, like I keep talking about, every action has a reaction, and we're not going to get out of this pain-free. Either central banks are going to have to do their job, lift interest rates, bring inflation down, we enter into a global recession, or they're going to pivot, and guess what? It's going to be very, very hard for you to afford your rent, your food, your fuel, your utilities, because inflation crisis is only going to get much, much worse. And guess what? The governments love inflation because it devalues their debt and it makes it easier for them to service the debt. But it's going to sacrifice the poor and the middle class in the process. So everyone, this is a key critical point in the markets right now. What do you all think? Let me know in the comments below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.